Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over non-liquidating distributions of non-cash property from C corporations. And we're going to be doing that the SuperfastCPA CPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam, and we teach you how to be effective and efficient with your studying. So make sure you go check that out. The link will be in the description. Also, just letting you know, we will only be going over 5 questions in this video, whereas Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. With that said, let's dive straight into the questions. All right, here is question 1. Blue Ocean Corp distributes a piece of equipment to shareholder Y. The equipment has a fair market value of $40,000 and an adjusted basis of $25,000. Shareholder Y assumes a liability of $50,000 attached to the equipment. What is the recognized gain for Blue Ocean Corp on this distribution? Okay, so we're going to be talking all about non-liquidating distributions in this video. We're going to be talking about what the recognized gain is for the corporation, how to calculate the gain if there's any gain for the shareholder, what the shareholder's basis is, and some different things like that. So if you don't really know how this works, that's okay. We're going to dive straight into the answer for this one so we can start learning. All right, the answer is $25,000, so let's read this explanation. The recognized gain for the corporation is calculated as the greater of the fair market value of the property or the liability assumed by the shareholder less the adjusted basis of the property. So between the two, between the fair market value of the property or if there's a liability assumed by the shareholder, whichever one of those is greater, that is the fair market value that's used for the gain recognition. So in this case, the liability assumed was $50,000, which is bigger than the fair market value of $40,000. So we use that as the fair market value, subtract the adjusted basis of the equipment, and that gives us a $25,000 recognized gain. And just letting you know, for C corporations in this case, non-liquidating non-cash distributions, they do have to recognize any realized gain from these transactions. All right, not too difficult to figure out what the recognized gain is for the C corporation when they distribute this stuff. Now let's go to the next few questions to learn about how this works for the shareholder. Okay, here we are at question 2. Green Valley Inc. has accumulated earnings and profits of $100,000 and current year E&P of $50,000. The company distributes a piece of land with a fair market value of $80,000 and an adjusted basis of $30,000 to shareholder Z. How much of the distribution is considered dividend income for shareholder Z? All right. If you have no idea how to do this, that's okay. The next few questions are going to kind of build off of each other. So let's dive straight into the answer for this one to start that base. Okay, the answer is that $80,000 will be counted as dividend income. So let's read through this. The dividend income for the shareholder is the amount of the distribution to the extent of the corporation's current and accumulated earnings and profits, or E&P. And the company has $100,000 of accumulated E&P, $50,000 of current year E&P, so that's a total of $150,000 of E&P. The distribution is considered the fair market value of the land. And since the total E&P, which is again $150,000, is greater than the distribution of $80,000, the entire distribution amount is considered dividend income in this case. And again, we're going to build on this to see what else can happen in these cases. But one thing I wanted to note, even if a corporation has a negative accumulated earnings and profits balance, so let's say they had like a negative $30,000 E&P accumulated from previous years, they can still have current year earnings and profits, and that can be used to count as dividend income from these distributions. And that will maybe make a little bit more sense with the next few questions. But what I'm trying to get at is you always take distributions out of current E&P before accumulated earnings and profits. And that matters because, again, if you have current E&P, you can still take distributions counted as dividend income, even if you have negative accumulated earnings and profits. Let's go to the next questions to make that a little bit more clear. Okay, here is question 3. Sunrise Enterprises has accumulated earnings and profits of $80,000 and current year E&P of $40,000. The company distributes a building with a fair market value of $160,000 and an adjusted basis of $90,000 to shareholder K. What amount of the distribution is considered a non-taxable return of capital for shareholder K? Okay, so we learned about some of it being counted as dividend income in the previous question, but now it's asking us, what is the return of capital? Again, if you don't know how to do this, that's okay. We're going to dive straight into the answer to build off what we learned in the last question. Okay, the answer is $40,000. So this, again, is building off of the previous question. So we're going to learn a lot more about how it works for the shareholder when these distributions happen. So let's look at this. The distribution is treated as follows. First is dividend income. The portion of the distribution up to the corporation's total E&P is considered dividend income and is taxable to the shareholder. This is because distributions are first applied against current E&P and then accumulated E&P. Next is return of capital. Any amount that exceeds the total E&P is a non-taxable return of capital to the extent of the shareholder's basis in the stock. This reduces the shareholder's stock basis. And this is what we're going to be dealing with in this question. If the distribution fair market value is greater than the total E&P, then the amount that exceeds the total E&P is considered a return of capital, and this is non-taxable. However, this last part, if the distribution exceeds both the E&P and the shareholder stock basis, then the excess is treated as a capital gain and is taxable, or basically a recognized gain. So now that we've learned about all that, let's do the calculation for this question. So of course, the total E&P is $120,000, and that's the current and the accumulated E&P. The distribution, again, is the fair market value of the building, unless there was a liability that was greater than the fair market value, but in this case, it didn't mention that. So the first $120,000 is from E&P, so that's dividend income. The remaining $40,000 of the $160,000 distribution is greater than the E&P, so it's considered a return of capital. It didn't really mention the shareholder's stock basis in this question, so we're just assuming that it's all a return of capital. But like we learned, if the distribution exceeded both the E&P and the shareholder's stock basis, then the remaining amount would be a capital gain. But in this case, there's $40,000 of return of capital. And again, this is non-taxable for the shareholder. All right, we're going to build on this one more time in the next question. You can probably guess what we're going to talk about. Let's go to the next question. Okay, here is question 4. Sunset Horizons, Inc. has accumulated earnings and profits of $90,000 and current year E&P of $60,000. The company distributes a piece of equipment with a fair market value of $250,000 and an adjusted basis of $100,000 to shareholder L. Shareholder L's basis in the stock of Sunset Horizons, Inc. is $70,000. What amount of the distribution is considered a taxable capital gain for shareholder L? Okay, we built on this in the previous two questions. You can probably figure this out with what we just talked about. So pause the video, do the calculation, and when you're ready, come back. We'll look at it together. Okay, the answer is $30,000. And again, we just talked about this. It's dividend income up to the amount of total E&P, and then it's a return of capital up to the shareholder's stock basis, and then anything over that is a capital gain for the shareholder. So the distribution was $250,000, and that's the fair market value of the equipment. The total E&P was $150,000, and the shareholder stock basis was $70,000. So the first $150,000 is dividend income. $70,000 is a return of capital, and then there's still $30,000 left of the distribution that has not used up E&P or the shareholder stock basis. So that is considered a capital gain. That is the recognized gain that is taxed for this shareholder. All right, those three questions kind of built off of each other, so let's go to the next question. Okay, here is question 5. Maple Tree Corporation distributes a warehouse to its shareholder, Emma Johnson. The warehouse has a fair market value of $300,000 and an adjusted basis of $120,000. Emma assumes a mortgage of $180,000 attached to the warehouse. Emma's basis in her Maple Tree Corporation stock is $50,000. What is Emma's basis in the warehouse she received? Okay, we've talked about the C Corporation's recognized gain. We've talked about how the distribution affects the shareholder as far as income and gains and everything. Now we're talking about what is the basis of the property for the shareholder when they receive it. Now it's pretty easy, pretty straightforward, but you may not know how to do it. So let's go into the answer. Okay, the answer is $300,000. And again, this is quite straightforward in all honesty. To determine Emma's basis in the property, which is the warehouse she received, we need to consider the fair market value of the property and the liability assumed by her. The basis of the property received by the shareholder is the fair market value of the property at the time of the distribution, typically. Like, that's the easiest way to think about it. However, if the property is distributed subject to a liability, the shareholder's basis in the property is the greater of the fair market value or the liability assumed. Basically, if the liability is greater than the fair market value, then that is the new fair market value or the new basis that is used for the shareholder. In this example, that's not the case. The fair market value of the warehouse was $300K and the liability was $180K. So for Emma, the basis is the fair market value, which is $300,000. And again, that is the basis that she will have in the asset now that she's received it. Okay, we've learned a lot from just 5 questions. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the material, doing the questions, you will notice the things that keep popping up in the questions. You will notice the equations, the topics, the information that you obviously need to know because you've seen 4 or 5 questions going over the same topic. So you take a moment and you write down your pillar topics so that you have them and remember them for later. With that, let's go to the pillar topics for this video. Okay, here are the pillar topics. First, for the corporation's gain recognition, C corporations must recognize any realized gains from distributions of property. And to calculate that, it's fairly easy. The recognized gain is the greater of the fair market value of the property or the liability assumed by the shareholder minus the corporation's basis in the property. Now, the next 3 points are about the shareholder. Distributions to shareholders up to the company's current and accumulated earnings and profits are considered taxable dividend income. Any distribution amount exceeding the company's E&P is considered a non-taxable return of capital to the shareholder. And then finally, if the distribution exceeds both the company's E&P and the shareholder's stock basis, the excess is taxed as a capital gain. This is a realized and a recognized gain. Again, this is recognized, so it will be taxed. And then finally, this one's pretty easy. The shareholder's basis in the property received is the greater of the fair market value of the property or the liability assumed by the shareholder. And typically it's the fair market value, but there can be situations where the liability assumed is greater. And with that, those are the pillar topics for this video, and that's the end of the video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. We teach the key ingredients to passing the CPA exam, and again, it is free. It is only 1 hour long, and we will teach you how to be effective and efficient with your study process. Also, if you liked going through these 5 questions with me, just remember that Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you want more of this, you can get more of it by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. Thanks for watching. I hope this was helpful, and I will see you in the next video.